There's a $30 trillion market that most people have never even heard of. Banks aren't lending the way they used to. So who's filling the gap? Private funds you can't see into, backed by money you didn't know was exposed to it. And some of it might already be yours. For decades, if a company needed a loan, it went to a bank. Simple, regulated, visible. But after 2008, regulators cracked down hard on banks. More capital requirements, more oversight, more restrictions on risky lending. So the lending didn't stop. It just moved. It moved into an entirely different system, one with almost none of those same rules. It's called private credit, and it has exploded from about $500 billion a decade ago to roughly $1.5 to $2 trillion today. Here's the part that should get your attention. The addressable market, meaning how big this could eventually get, is estimated at over $30 trillion. This isn't a niche corner of finance anymore. It's becoming the plumbing of the entire economy. So what actually is private credit? Instead of a company borrowing from a bank, it borrows directly from a private fund, run by firms like Apollo, Ares, Blackstone, Carlyle, KKR. No public markets, no public disclosures, no credit rating agency independently checking the books. Just a private lender and a private borrower making a deal behind closed doors. For years, this was mostly institutional money, pension funds, insurance companies, sovereign wealth funds, people with the ability to absorb risk, and the teams to actually analyze what they were buying. But that's changing fast. Regulators recently opened the door for private credit to be sold into retirement accounts, a market worth over $13 trillion. And retail allocation into private credit is projected to grow nearly 80% a year, from about $100 billion today to an estimated $2.4 trillion by 2030. Translation: the exact same asset class that institutions use teams of analysts to underwrite is now being packaged and sold to everyday investors, through funds advertising steady, attractive yields. Here's why that should make you pause. When you buy a public stock or bond, there's a mountain of disclosure. Quarterly earnings, independent audits, a price the entire market agrees on, updated every second. Private credit has almost none of that. The loans aren't traded. The value isn't set by a market. It's often estimated by the same firm that made the loan in the first place, which means during a downturn, we may have no real-time way of knowing how bad the damage actually is until it's already happened. And this is where it gets structurally dangerous. Regulators have flagged that private credit funds, banks, and insurers are becoming deeply intertwined. Banks lending to the funds, insurers buying into the funds, funds lending to companies banks won't touch anymore. It's a web, and webs don't fail in isolated corners. They fail together. This isn't a prediction that a crash is coming tomorrow. Nobody can tell you that. And if they claim they can, they're lying to you. What we do know is this. Every financial crisis in modern history had one thing in common. Risk quietly moved to wherever it was hardest to see, in the years right before it became impossible to ignore. When 8 was about mortgages, nobody was watching closely enough. This might be about corporate loans nobody's watching closely enough, sitting in retirement accounts advertised as steady and safe. You don't need to panic. You need to know what you actually own. If a fund is promising you a high, stable yield and you can't clearly explain where that yield is coming from, that's the moment to ask more questions, not fewer, because the pattern is always the same. The risk doesn't announce itself. It just sits there quietly until one day it doesn't. Subscribe if you'd rather understand where the risk is hiding before everyone else finds out the hard way.